Hello everybody. I hope you are fine wherever you are. I am the ACCA tutor, Mr. James Mkulu from Transcal Consulting Services. In this lecture, we are going to touch on the area called depreciation. This is part of an area which is examinable in the ACCA paper, financial accounting, as well as financial reporting and strategic business reporting. This video is going to be of assistance to students studying any of these papers. It is also useful to university students who are studying accounting, or those ones studying other professional accounting qualifications like the CPA or the chartered accountant, and so many. So without wasting much of your time, let us go straight to business of the day. Our objectives. By the end of this presentation, students should be able to explain what depreciation is all about. Okay, we need to be able to explain what let me just look for a pen here. I'm looking for a pen so that I will be annotating here and there for the benefit of our understanding. Okay, we should be able to explain what depreciation is and why it is needed. Identify different methods of calculating depreciation, of which they need to be aware, and the accounting entries applicable. Lastly, students should be able to understand the accounting for revaluation of non-current assets. So these ones are our major objectives for the lecture. You might also have to appreciate that there are certain things we'll be talking about which are not part of these main objectives, but they are necessary for your attention of the depreciation area as well as the revaluation area of accounting for non-current assets. Now, depreciation. What is it? Alright, depreciation is usually considered the most challenging area when it comes to financial accounting. But basically, depreciation is all about the allocation. Okay? Allocation of the cost of an asset over its useful life. What are we talking about when we are saying it is an allocation of the cost of an asset over its useful time? We are being taken to the concept of matching, the matching concept. The matching concept says that expenses incurred in a period or for a period should be matched with the revenue for that period. So let's say you have bought an asset which is going to be in business for 5 years. Would it be logical to expense the whole cost of the asset in 1 year in which the asset was bought, when we know that this asset is going to be used over the 5-year period? So in the mind of view of the accountant or accountants, it is not reasonable or fair to charge or to expense the whole cost in one accounting period, but it should be spread over the life of the asset. But we need to know what asset are we talking about. In this case, we are talking of non-current assets. Those assets which are not going to be used in 1 year, but they are going to be used by the business over 1 year. So they are long-term asset. They are non-current. Right? Now, a non-current asset is an asset intended for use on a continuous basis in the business. Alright? A tangible non-current asset is one that can be touched and refers to such items as plant, buildings, and motor vehicles. So when you are thinking of tangible non-current assets, these ones are actually fixed. They an example of them would be plant, buildings, and motor vehicles. Alright? These assets are going to be used in a business over a 1-year period. Okay? So what's most important is they should be there over a period of 1 year. That is in terms of International Accounting Standard number 16. Okay? International Accounting Standard number 16, as well as International Accounting Standard National Accounting Standard number 1. Alright, National Accounting Standard number 1, that is presentation of financial statements, and then National Accounting Standard number 16, that is property, plant, and equipment. Alright, those are the guiding standards when it comes to non-current assets, their definition. Alright, you might also have to refer to what is called the conceptual framework. Might be of assistance there. But when you're talking of, there's so many accounting standards which relate to non-current assets, but these ones are for the two which I've given you are actually good at this level for you to appreciate what non-current assets are. Alright, so there are also non-current assets which are intangible. Alright, these ones are those which cannot be touched and refer to such items as goodwill, patents, and so forth. So we'll cover these ones in the later lectures. Alright. Now, we've just discussed this one, that depreciation is the charging of the cost of a non-current asset over its useful life. Over its useful life, which means that depreciation is not going to be charged in 1 year only, but it should be spread over the life of the asset. Alright, the purchase of a car for $10,000 is an expense of running the business, just as electricity is an expense. However, if the car is expected to last 5 years, it would be misleading to have one expense in the statement of profit or loss of $10,000 every 5 years and nothing in the other year. Alright, we are simply saying that it's not logical to charge the whole expense in just 1 year and neglecting the other years in which the asset would be in use. So it would be more sensible to reflect the fact that the car is being used in the business over 5 years by charging an expense each year of, say, $2,000. That is $10,000 over 5 years. So every year we're going to charge $2,000. The charge of $2,000 in the statement of profit or loss each year is known as depreciation. At the same time, the statement of financial position value of the car will be reduced by $2,000 each year to reflect the fact that it is being used up. Remember, when we buy an asset, we debit, let's say for this car, we debit motor vehicles, 10,000. So initially when we purchase this car, and we credit bank. If we had bought this car on cash, using our bank account. But sometimes we might have to credit payables. If we have been given the car on credit, then there should be a payable created on the date of the purchase of $10,000. Remember, the debit and the credit should balance by the end of the day. Now, what does this mean, that debit motor vehicle? We are saying that when we purchase a car, an account has been created in our records, and in the statement of financial position or balance sheet, we are going to see the car under the non-current assets. Non-current assets of the balance sheet, we are going to see motor vehicles, $10,000. But this is at the beginning of the year. Let's say the beginning of the year was 1 January 2022. But at the end, we're going to see at 31 December now, at the end of the year, 31 December 2022, we are going to see under the non-current assets, motor vehicles. The motor vehicles would be showing 8,000. Why? Because we have considered the depreciation of the motor vehicle of $2,000. That's the thing, ladies and gentlemen. Okay? That's the thing here. Alright, so the purpose of the depreciation is not to place a true value on the asset in the statement of financial position. It is a method of applying the accruals or matching concept, which we have just discussed. Alright? By charging the cost of the asset to the statement of profit or loss as it is being used up. Okay, please just don't forget this statement. It's actually a very, very strong statement, and usually when we are confronted by the multiple choice questions, especially in ACCA papers, you end up being dazzled by by failing to make the right choice, okay, or to choose the right option. For example, the examiner might say, what is the purpose? From the following statements, which statement explains the purpose of depreciation? Alright, and the examiner would say, 1, it is to place a true value of an asset in the statement of financial position. 2, it is a method of applying the accruals or matching concept by charging the cost of the asset to the statement of profit or loss as it's being used up. And then the examiner would say, item 1 is correct or is true, but item 2 is not. Or item 2 is correct, but item 1 is not. Or both statements are correct, or both statements are not correct. You can see that only item 2, which will be saying that it is a method of applying the accruals or matching concept by charging the cost of the asset to the statement of profit or loss as the asset being used up, is the correct one. So you need to pay very careful attention to the wording, to these definitions, to these concepts. Alright. Now, there are there are various methods of calculating depreciation, but for the purpose, especially for the ACCA FA paper, that is the financial accounting paper, we are only worried with the straight line method and reducing balance method. Now, for the straight line method, under this approach, we charge an equal amount of depreciation each year. The depreciation charge each year is calculated as original cost of the asset minus any residual value. When you are talking of a residual value, this is the value the entity is going to receive upon disposal of that asset. Let's say after 5 years, we can't actually give the car for free. we normally charge a certain value so that we recover something. So that something is what we call residual value. So for the purpose of computation of depreciation under the straight line method, we are going to say original cost of the asset minus the residual value, all divided by the estimated useful life of the asset. Let us understand this by doing the following example. Sakans has a year end of 31 December each year. On 1 April 2002, he purchases a car for $12,000. The car is expected to last for 5 years and to have a scrap value at the end of 5 years of $2,000. You are required to calculate the depreciation charge of the first 3 accounting periods and to show extracts from the statement of financial position and statement of profit or loss for each of the 3 accounting periods. So let us do this one straight away. But we need to identify the variables from the scenario. Which one is the original cost in our formula? The car was costing $12,000, but the car has got an estimated useful life of 5 years and the residual value is $2,000. So we now know the values, and it now becomes easier for the computation. But one thing for certain is that you have to understand or to know that dates in each scenario, the dates are very important. The date when the asset was acquired. When was the asset acquired? You can see that in this case, we are told that the year end is 31st December. That is, this year end is actually an ordinary year end, okay? And an ordinary year end is that one which ends at 31 December. All right. So we are also told that the asset was bought on 1 April 2002. So 1 April, that is 3 months into the year, the asset was bought. So this asset in the first year, it was only used by the business for only 9 months. For only 9 months. So depreciation is going to be charged in the first year based on 9 months usage. Okay, it was used by the business for 9 months. So depreciation should be apportioned proportionately or allocated proportionately. So let us do the workings right away. So depreciation per annum is going to be, depreciation per annum is going to be, the original cost of the asset was 12,000, all right, and the residual value was 2,000, all divided by 5 years, and this gives us, that's 12 minus 2, that's 10 over 5, 2, so $2,000 per annum. Okay. Now, the question is saying that we then have to, after calculating the depreciation, we have to show extracts from the statement of financial position and statement of profit or loss. All right. So before we do that, let us determine the depreciation for each depreciation charge for each of the first 3 years. So we are going to have year 1, year 2, year 3, and so forth. So for year 1, the asset was in business for 9 months. So 9 over 12 multiplied by $2,000. We are going to have a charge of 1,500. Please use your calculator to confirm. Then for year 2, we just use this value, the full 2,000. Okay, the full 2,000. All right, that's okay. Now let's now do the extracts. Now let's now worry about the extracts. Financial statement extracts. Remember, we are only required to show this information in two financial statements as extract. When you are saying extract, you do not have to write the whole statement of profit or loss, because you do not have other information about the sales, etc. and so forth. The only information the examiner wants to see is the extract, the portion of that statement. So let us start with the statement of profit or loss, because remember, depreciation is an expense, so it is charged to the statement of profit or loss. Okay, but it has also a bearing in the statement of financial position, as it reduces the asset values. All right, so let's start with the statement of profit or loss. Okay, statement of profit or loss, where we are having depreciation as an expense, and we are having year 1, year 2, year 3. Remember, these are end of year 1, end of year 2, end of year 3, or you can just simply say 31 December 20x1. In this case, let us just use the dates from the question. We are told the asset was bought on 1 April 2002, so we can simply say year 1 is actually 2002. This one is end of year 2003, end of year 2004. Okay, so depreciation, as we have already calculated, we can see that for 2003, that's 1.5, 2004, that one, this is 2002, sorry, 2002, 2003, and then 2004. All right, so for 2002, that's 1.5. Charge was 1,500. Let us put our dollar signs here, because the examiners might be worried. And for the rest of the years, it was full 2,000, which was being charged to the statement of profit or loss. Then we are done. We go to the statement of financial position, SFP. The SFP extract, here we need to first show the cost of the asset. The asset at the cost, we are told that the asset at cost was 12,000. The car was bought at 12,000. So every year the cost would be the same, $12,000. However, the depreciation now, less accumulated depreciation. The accumulated depreciation, ladies and gentlemen, is that, the total of all the depreciation charges that have been levied on the asset. Okay, all the depreciation that had been levied on the asset. And it's very simple. All right, for year 1, the accumulated depreciation was 1,500. Okay, that's for year 1. All right, for year 1. Remember, the accumulated depreciation is going to reduce the asset. But for year 2 now, for year 2, can we take 2,000? Obviously it can't, because for year 2, the accumulated depreciation, it means that we are going to add the first year, this one, plus the year 2 depreciation. So the accumulated depreciation becomes 3,500. Okay, and then for year 3, or in 2004, the depreciation charge would be this one plus this one plus this one, and this becomes 5,500. So let us then find what is called the net book value. The net book value of the asset, this one is the cost less accumulated depreciation. And for the first part, we are having 12,000 minus 1.5. This gives us 10,500. And then 12,000 minus 3,500, this gives us 8,500. And then 12,000 minus 5,500, this gives us 6,500. Okay. We also have to note that in the first accounting period, we have charged the fraction, as I have indicated there. Okay, we have charged the fraction, a fraction, because the asset was bought midway. Alright, so this means that in the exam, you just have to be very careful with the dates. I have emphasized that point. Now, the reducing balance method. Under this approach, we charge more depreciation in the early years of an asset's life, with a progressively lower charge in the subsequent year. The depreciation charge each year is a fixed percentage of the net book value or written down value at the end of the previous year. One thing I want to elaborate or to emphasize on this reducing balance method is that the examiner might be interested in you showing him when the reducing balance method is going to be used. Alright, the reducing balance method is used when we want to charge more depreciation in the early years or initial years in the usage of the asset. Okay, so he might also ask you which of the following would call for a reducing balance method. Which of the following assets would call for a reducing balance method? The assets which are typically chargeable under the reducing balance method includes assets like computers and so forth. Those assets which usually are useful in the initial years or in their early years or early life. They are useful, but their usefulness deteriorates with time. Okay, you can't use a straight line charge because computers are usually effective in the first year or 6 months, but when time goes, they start to deteriorate. So the reducing balance method is usually useful to assets which are useful in their initial years. Now let us do example Matokosisa. Matokosisa has a year end of 31st December each year. On 5 April, he purchased a machine for 15,000. On 5 April, okay. His depreciation policy is to charge 20%, reducing balance, with a full year's charge in the year of purchase. So we are told there is this qualifying statement that do not worry about when the asset was bought, because whether it was bought on 25 December or it was bought on 1 January or on 1 March, we are going to charge a full year depreciation charge in the year of purchase. That's their policy. Okay, so with that background, let us quickly deal with the problem. Now, remember, we are using reducing balance. Reducing balance method. That's the method we are using, ladies and gentlemen. So let us first calculate our depreciation charge each year. Okay, so we are going to have to start with the cost of the asset. The asset was, from the question, the asset was 15,000. Purchased at $15,000. And then we have to say year 1 depreciation at 20%. Remember, we are going to charge 20% of 15,000. That's 3,000. And we are going to have a net book value year 1 of 12,000. Okay, that's the NBV year 1. And then year 2 depreciation, year 2 depreciation at 20%. This 20% is not going to be charged on the 15,000, ladies and gentlemen. This is a reducing balance. The 20% is going to be charged on the net book value after the depreciation charge in the previous year. Okay, so it is 20% of 12,000 this time. So this gives us 2,400. Okay, so if we use our calculators, we are going to have a net book value year 2 of 9,600. So that's NBV of 9,600, and then depreciation charge year 3 becomes 20% of 9,600, and this becomes 1,920. Okay, we reduce this one, we deduct this one from the 9,600, and we are left with 7,680. Okay, this is the NBV year 3. NBV year 3. Okay, now we have sorted out our depreciation charges. What we then do is to attend to the extract, because the question wants us to show extract. Okay, show the extracts. So we simply go to our drawing board and come up with a table showing each year. Okay, so we start with the statement of profit or loss. Profit or loss. And here the depreciation charge is an expense. So the depreciation. And we just have to slot in these figures: 3,000, 2.4, 19, 20. So you can see, because this one is a reducing balance method, the depreciation charges are going down as the asset progresses. In terms of the lifespan. Okay, in terms of its usage or its time or length of period in the business. As the years increase, the depreciation charge decreases. It started as 3,000, fallen to 2.4, and then 1.9. So it was falling. That's the reducing balance method. So let us slot in those figures. In the first year it was 3,000, then 2.4, and then 1920. 1920. Then the statement of financial position extract. The statement of financial position, we are going to have under the non-current assets, we are going to have the cost of the asset. The cost of the asset, ladies and gentlemen, it was 15,000, remember, so that's $15,000. Okay, so remember, always put your dollar signs so that examiners would see clearly. Then less accumulated depreciation. Accumulated depreciation. Okay, in the first year obviously it was 3,000, but in the second year that's 3,000 plus 2.4, so this becomes 5.4, and plus this one for the third year, it becomes 7,320. Okay, so the NBV, okay, would be 12,000 in year one, okay, and then it came to 5,000 for, 9,600. That is 50 minus 5.4, 9,600. And then 7,680. There we have attended to our problem, ladies and gentlemen. Okay. Now, accounting for depreciation. We have to be, comfortable with the double entry bookkeeping that is required. Accounting entries applicable to each depreciation method are just the same. So whether you are using the reducing balance method or the straight line method, the accounting entries themselves for depreciation are just the same. Alright, so whenever you charge a depreciation expense, you then have to debit the expense and credit the accumulated depreciation. Remember our PL's acronym. In our PL's acronym, we said that the first three letters are increased by debiting, then the last three are increased by crediting. And we say that P was for purchases, E expenses, A assets. So whenever you make a purchase, you have to debit purchases. Whenever you incur an expense, you have to debit expenses. In this case, depreciation, you have to debit depreciation. Alright? And then, whenever you buy an asset, you debit the asset. You debit the motor vehicle account. But, whenever you make a sale, that's revenue. Let me just use another pen. R is for revenue or sales. Whenever we make a sale, we credit sales. Okay? We credit income. Sometimes income. Okay? Sometimes profit, retained profit, etc. Alright? And then L is for liabilities. Payables, etc. Loans, bank loans. Okay, we credit them. Alright, whenever we enter into their transactions, we credit them. Okay, let's say you have entered into a liability arrangement. We credit the liabilities. And then S, this one is for capital, share premium, and so forth. So we are talking of capital here. Alright, so all these are increased by crediting. These ones increased by debiting. So this is what is happening there. Whenever we incur a depreciation expense, we have to debit depreciation expense account and credit accumulated depreciation account. Okay. So the balance on the depreciation account will appear in the statement of profit or loss as an expense. The balance on the accumulated depreciation account will appear in the statement of financial position as a deduction from the cost of the asset. Alright. Let us do this example together. Let us do example Zenica. Let us do example Zenica together. Okay. I like this name. So motivating, isn't it? Alright. Zenica has a year end of 30 June each year. On 1 January 2002, he purchased a car for $15,000. The car has an expected life of 5 years, with an estimated scrap value of $1,000. Zenica's depreciation policy is to use straight line depreciation. Show the accounting entries for the first 3 accounting periods. So, ladies and gentlemen, we have this important information. The year end, in this case, for the Zenica company is 30 June each year. Alright, so it means that the year end is not fixed in the accounting sense. The year end is not always 31st December. That is why I said in our first example that that year end was actually an ordinary year end. But it doesn't mean that every company is going to follow the ordinary year end. Other companies have got their year end in January, others in June, others in April. It depends. Okay. So on the 1st of January 2002, he purchased a car for $15,000. Alright, and the expected, so this is the cost of the car, and this is the estimated life of the asset, and the scrap value is $1,000. The scrap value is also the residual value. So the depreciation should be 15,000, which is the cost of the asset minus the residual value of 1,000, all divided by 5 years, and we are going to have a charge of 2,800 per annum. Okay, 2,800 per annum. But you can see that for the first year, the asset was bought on 1 January. 1 January is almost about 6 months after, into the year, because the year starts on 1 July. Okay, the year starts on 1 July and ends on 30 June every year. So if we buy an asset on 1 January, then we bought that asset 6 months into the year. So this would mean that for year 1, the depreciation would be year 1 depreciation should be the 2,800, okay, multiplied by the 6 months, 6/12. Okay, and we are having a depreciation charge for that for the first year of 1,400, and the other years would be charging 2.8. Okay, now we are required to show all the relevant entries with regard to this transaction. They bought a car, so let us create a car account. Okay, car account or motor vehicle account. The car account should be a good T account like this one. Remember, a car is an asset, and from our PO's acronym, which I have already illustrated, we say that assets are increased by debiting. So we are going to have a debit. Cash. The car was bought for 15,000 on cash. So $15,000 debit. That's our car account. What about the accumulated depreciation account? the accumulated depreciation account. Okay, I think that one is also a good account to deal with first. All right, so we can have the accumulated depreciation account. It is also a T account. Okay, the asset was bought on 1 January 20 x2, so the year end is 30 June 20 x2. Okay, so we can just say 2002. Okay, and remember, this is an accumulated depreciation account is by default a credit balance. Okay, so it is on the other side where the entries or the transactions would be increased by crediting. So depreciation expense for that year was 1,400. Okay, because we determined that the first year, this is the year 2002. Okay, we said that it was 1,400. Okay, and then we then have to go to 2003, year 2003. Okay, for the 2003 year, we are going to charge a depreciation expense of 2.8. Okay, the full year charge 2.8. all right, so if we add up, we get 4,200. Okay, 4,200. If we balance up, it's 4,200. Okay, so this is the balance. Okay, the balance CD so far is at 2003. That's 4,200. Then we take this balance in 2004. The balance would be 4,200 is our opening balance. Okay, and this is 2004 at the beginning. Okay, this is the opening balance, and then at the end of this year, we are going to charge a depreciation expense for that year, which is going to increase this by 2.8. You know, because every year we're charging 2.8. Okay, so if we add, we get 7,000. Then you have to ensure that the debit side is also having the 7,000. All right, so the total accumulated depreciation should be 7,000 at the end of 2004. So we're going to have an opening balance for 2005 as 7,000 accumulated depreciation. All right, that is what is happening, ladies and gentlemen. Okay, now as for the statement of profit or loss, the depreciation charges or depreciation expense account. Depreciation expense account. Okay, now depreciation expense is a statement of profit or loss item. So whatever depreciation we charge, it is transferred or expensed to the profit or loss immediately. So we are going to have remember I said depreciation is an expense, therefore it is increased by debiting. So we are having, for the first year 2002, we have got accumulated depreciation, okay, of 1,400. But this 1,400 is going to be expensed to the profit or loss. Okay, statement of profit or loss is 1.4. Okay. Then in 2003 again, there is accumulated depreciation of 2.8. Okay, and this is immediately transferred to the statement of profit or loss as a charge of 2.8. Remember, these expenses, the depreciation expense is not going to be like having the balance brought forward and this and that. No, what has got the balance brought forward is the accumulated depreciation. The depreciation itself is just charged for each accounting period. The charge goes straight without having some, some balance that is going to be carried forward and this and that. Okay, so this is the matching concept. Expense for that period is going to be charged in that period. Okay, so do the same 2.8. Then for 2004, we've got accumulated dipping of 2.8 as above. Okay, so 2004 statement of profit loss, that's 2.8. We do the same 2.8, and do the same. Okay, so but what is important is you need to know that this is the charge that is going to go to the statement of profit or loss in year 1. In year 2, you're going to have this one. In year 3, that one. And you are home and dry. Now, let us consider a situation when we sell an asset. Okay, what happens? Which accounting entries do we have to prepare when we sell a non-current asset? Okay, this summary is very important. Okay, summary of the accounting entries whenever a sale of a non-current asset takes place. The first thing you have to do, you have to debit the disposal account and credit the asset account with the cost of the asset sold. Why are we crediting the asset account? Because if we go back to our POs, okay, I've already deleted it. I said that assets by default are debit entries, okay, or debit balances. So whenever we want to reduce the debit balances, we have to credit them. So this is why we are crediting, because we have disposed of the asset. So we have to credit the asset account and debit the disposal account. A disposal account is actually a temporary account to account for the disposal of the non-current asset. So what happens again to the accumulated depreciation account? Remember, this account, I said it is on the other side of the PO's acronym, which is increased by crediting. So when we want to close that account, we debit it. When we want to reduce that account, we debit it. So this is why we are debiting the accumulated depreciation account and crediting the disposal account with the accumulated depreciation of the asset. Lastly, we have to debit the cash because we have received the cash and credit disposal account with the proceeds of the sale. The balance remaining on the disposal account is then transferred to the statement of profit or loss as a profit on disposal or loss on disposal. Okay, so this is the information we are going to use, ladies and gentlemen, in our example. We are simply going to use the same information we have used in our example Shenika. That's example 3 there. So we are going to use the same information and the same workings there. Remember, at the end of 2004, we said that the balance was $7,000 there, okay, and which becomes an opening balance in the year, in a new year, that is going to end in June 2005. Okay, so with the balance of 7,000 as our accumulated depreciation, we then have to consider whether there was any other depreciation that was supposed to be charged when the asset was disposed. Alright, so let us first start by drawing up the car account. The car account is as follows. We know that the car was bought on cash, okay, or let us just say the balance on the car account was 15,000, okay, was 15,000. All right, but the car was disposed of, okay, so we no longer have the car. All right, so the car would be disposed. No car at all. Okay, there is no car. But we have to know how to treat all these issues in our accumulated depreciation account. The accumulated depreciation account, all right, like I already indicated, we had a balance of 7,000. Okay, but the asset was sold. The asset was sold on 30 September 2004. So 30 September from the year starts at 1 July. So July, August, September. So it was sold 3 months into the year. So the depreciation expense should be 3/12 multiplied by 2,800, because every year the asset was being depreciated by 2,800. We don't forget, we have already calculated that there. So every year 2,800 was being deducted from the asset, but in this case only three months apply. Only 3 months apply. So which means only 700 is our depreciation charge. Okay, so if we add, we're going to have 7.7. Okay, so our balance should be 7700. So we take this balance as our opening balance. Okay, so the balance should be 770. Okay, but we are told that the asset has been disposed, so disposal 770. Okay, which means we have to transfer this accumulated depreciation to the disposal account as a credit. Okay, so in the statement of profit or loss, the depreciation charge for the year should be only the 700 for the 3 months. Accumulated depreciation 700. So the statement of profit or loss will have a charge of only $700. Okay, and then like I said, the 7,700, the accumulated depreciation ultimate balance, is going to be a charge, is going to be a credit to the disposal account. Okay, it's going to be a credit. So let us try to have the disposal account. Okay, the disposal account, we are having the car. Okay, the car at 15,000, which is being disposed of. All right, but we have to consider the accumulated depreciation balance of 7.7. Like I said, this should be credited to the disposal account. And then whatever cash we receive is also going to be a credit to the disposal account. So how much did we receive? We received 6,500. Okay. So the balancing figure should be the transfer to the profit or loss, either as a gain or a loss. If it is on the debit side of the disposal account, then that's a gain. If it is a credit side to the disposal account, then it's a loss. So if we try to add both sides, you can see that the debit side is larger. So automatically we are going to have a credit on the a credit balance. Okay, so I mean our balancing figure is on the credit side, so that's a loss. Okay, that's a loss. So statement of profit or loss, loss on disposal. The loss on disposal is a balancing figure of $800. Okay, you can also confirm whether you have done it right by knowing this, that profit on disposal is equal to sales proceeds less NBV of the asset. Okay, which is equal to, okay, let us say profit or loss on disposal is equal to sales proceeds minus NBV. The sales proceeds was 6,500 minus the net book value of the asset. Net book value, I said the asset cost 15,000 minus the accumulated depreciation 7,700, which becomes 6,500 minus 15,000 minus 770. This should be 7,300. And you can see that there is a negative of 800, which suggests that there is a loss. It means that the proceeds of 6,500 were lower than the net book value of the asset. So the asset was sold below net book value, which means there was a loss. Are we together, ladies and gentlemen? I'm sure there we are done. Okay, so this is how you were supposed to have attacked this question. Now, on revaluation of non-current assets, in the ACCA FA paper, you are not required to show much detailed knowledge of the subject area, but just the upper surface. Okay. During a period of high inflation, the value of non-current assets may be well in excess of their carrying value. Okay, that is the net book value. In this situation, a company may choose to show the current worth of such assets on their statement of financial position. Any profit resulting from such revaluation is an unrealized profit, in that the asset is not being sold and therefore no real profit has actually been made. As a result, the profit is shown separately from the statement of profit and loss in a revaluation reserve. For a limited company, this must be the case. For a sole trader, where the owner has unlimited liability, this is not a rule, even though it is good practice. International Accounting Standard number 16, property, plant, and equipment requires that when an item of property, plant, or equipment is revalued, then the entire class of property, plant, and equipment to which the asset belongs must also be revalued. This is a very important point, ladies and gentlemen, because we can't have a situation where certain houses, let's say a company has got a range of houses, okay, and other houses are being revalued, others are not. That's not going to sound good. So the standard specifically prohibits such segregation when it comes to revaluation of assets. Okay, so whenever a class of assets are being revalued, then the entire class should be revalued. Also take note that when it comes to the revaluation reserve here, in the statement of comprehensive income, the revaluation surplus is also shown under the other comprehensive income section, the OCI, the other comprehensive income section. Okay, this would also then relate to this SFP reserve section, the revaluation reserve. Please take note. So in the statement of comprehensive income, or the statement of profit or loss in the other comprehensive income, in the other comprehensive income section, that's when you are going to see the revaluation surplus. This is because of the issues which have been highlighted there, that there is actually no profit. There's no actual profit that has been made. It's only an issue of revaluation that has happened. Okay, so when a non-current asset has been revalued, the future charge for depreciation should be based on the revalued amount and the remaining economic life of the asset. Okay, the depreciation charge will be higher than it was before the revaluation, and the excess of the new charge over the old charge should be transferred from the revaluation reserve to retained earnings. Okay, now I think we should do this last example, and we call it a day. Raphael has a year end of 31st December each year. In his statement of financial position as at 31st December 2002, he has buildings at a cost of 3,600,000 and accumulated depreciation of 1.80 million. His depreciation policy is to charge 2% straight line. On 3rd June 2003, the building is to be revalued at 3.072 million. There is no change in the remaining estimated useful life of the building. So which means that the estimation when it comes to the lifespan of the building was just okay, but what is changing are the values. So show the relevant ledger accounts for the year to 31st December 20x3. So that's the data, ladies and gentlemen. We just have to come up with our buildings account. The buildings account, all right, buildings account. Okay, buildings are assets, so by default their balance should be a debit balance, and we are told that these assets, the cost of the asset was 3.6 million. Okay, and then we are also told that at some time the building balance was at some time the building had been revalued to 3.072. So that's 3072 million. Okay, so that's the thing then. So we then have to say how come building, what is happening. So we need to know if actually there has been some revaluation taking place. So 336. Okay, obviously a revaluation should have taken place because we know from the fact that the building was costing 3.6 million, but accumulated depreciation at some point was 1,080,000. So accumulated depreciation was 1080. Okay, so which means this building should have been having a net book value that is at 31 December. Okay, from the facts here. Okay, 31 December, that was the value of the building. So if we use our calculator, we can safely say the building was worth this much. Okay, 20 there. So there was some 5. So about that value. Okay, so that was the net book value of the building here. But we are also told that we also know these facts. So automatically you can see that this value and this value are indicating that there has been some revaluation taking place. So the revaluation account should realize the balance here. The outstanding balance should be a revaluation. So 528,000 should be the the balancing figure for this account. The balancing figure. Okay, but you see that this figure can also be found through other means, but anyway, let us do it gradually. All right, what about the accumulated depreciation? Accumulated depreciation for the building. Accumulated depreciation, we are told here that it was balance. Okay, balance. Sorry. The balance was 1080 million. Okay, and then there was some depreciation that took place. Remember, these transactions occurred what we know so far is that let me just try to change pen. Okay, the revaluation took place on 30 June. All right, which means that the revaluation took place 6 months into the year. Okay, 6 months into the year, that is in 2003. But we are told that our year end is 31st December, so that's 6 months into the year. And as at 31st December 2002, the accumulated depreciation had been 1.08 million. All right. Now, the revaluation took place in 2003, that is 6 months into the year. So which means we need to compute the 6 months depreciation before the revaluation and then the 6 months depreciation after the revaluation. Okay, so we can safely come here before, let me just say depreciation before revaluation. We are having 6 months, so that's 6 over 12 multiplied by the charge is 2%, okay, multiplied by the cost of 3.6 million, and we should have a depreciation charge of 36,000. Then that was before revaluation. What about after revaluation? After revaluation, we are going also to have a 6 months period multiplied by 2%. Okay, but in this case now, it's very, very tricky. Okay, in this case, it becomes very, very tricky. Okay, so to be a bit fair, we need to determine the number of years the building has to be useful to the business from the date of revaluation. All right, so how do we know the number of years? If we are using a 2% rate, it simply means that the building has to be in business for 50 years. Remember, 2% per year simply means that let's say the building is going to be there for 100% length of period. Okay, but we are charging 2% each year, so which means that this 100% should be 50 years, that is 100 over 2. Okay, 100 over 2, that's 50 years. All right, now at the date of revaluation, how many years have been consumed? At the date of revaluation, how many years had been consumed? So we have to be led by the accumulated depreciation. Accumulated depreciation so far should be 1080 plus this amount, okay, 36,000. So this should give us some 11. Okay, so the accumulated depreciation so far is 1,116,000. So which means that we need to know how much depreciation is charged every year. The depreciation charged every year is this figure 3.6, okay, 3.6 million multiplied by 2%. So which means every year these guys are charging 72,000. They're charging 72,000 every year. All right, so we know that our accumulated depreciation is 1,116,000. So the number of years so far consumed or related to this accumulated depreciation should be 1,116,000 over 72 72,000. 72,000 is the charge every year. Okay, that's the charge every year. So which means so far, according to our calculators, so far the amount of years consumed, that's 15.5 years. All right, so the number of years which are not consumed are now going to be 50 years minus 15.5 years, which means we are still having about 34.5 years. Outstanding. These are the years outstanding. Okay, so we are going to use those years, ladies and gentlemen. We are going to use those years to compute our after revaluation depreciation. So we know that the revaluation took place 6 months into the year, so the depreciation should be based on the last 6 months of the year. So the 6/12 multiplied by the new value of the building, that is 3,072,000, divided by the remaining useful life of 34.5 years. So this gives our depreciation charge of 44,522. Okay, so we then come here and say to our accumulated depreciation account, we have to add the depreciation charge of 36,000, which is for the first 6 months before the revaluation, and this takes us to 11116. Okay, 11116. All right, and the balance should also be 11116. All right, that is the balance we are having. Okay, all right, then we have to consider, let me just underline there, because there's been some, these revaluations. Then you have to consider also the revaluation account itself, right? But before we do that, remember this is a balance. Okay, that's 11116 thousand. But remember, there've been some revaluation, so carrying forward this accumulated depreciation is not going to be reflective of the revaluation, so it should cease to be carried forward. Okay, this balance is to be ceased to be carried forward. So there has been some revaluation, ladies and gentlemen. Okay, that's the revaluation there. Then we start a new depreciation expense of 44,522 as we have computed here. Okay, that's our accumulated depreciation expense account. And then what about the depreciation expense account? Alright, we are having the accumulated depreciation of 36,000 initially before the revaluation, and then the accumulated depreciation after the revaluation. Okay, after the revaluation. Okay, and this gives us a total of 80,122. All right, and remember, the depreciation charge should be transferred to the statement of profit or loss. So the S/P transfer should be the ultimate balancing figure. All right, the last account we need to worry about is the revaluation account. The revaluation account. Okay, the revaluation account, where we have to the revaluation account. We then have to debit this account with the building revaluation balance we already determined in our initial computation. Okay, so that's the 528,000. All right, but one thing for certain you have to understand is that the revaluation account is to be credited by the accumulated depreciation. So our accumulated depreciation so far was, is 116,000. All right. All right. So the idea here is to determine whether we are having a gain or a loss on revaluation. So you can see that if we are having a loss on revaluation, then the balancing figure should be on the credit side of the revaluation account. But when it is on the debit side, then we are having a gain. So gain on revaluation should be the difference here, which is 588. But how do you know that your revaluation here is correct? This is why I say that this figure, initially I indicated that it should be found using the other means. So let us start by determining how you can safely say your revaluation computation was fine. All right. The trick is simple. You can use the same technique we used when we were confirming if the asset disposal was correct. We can use the same thing, all right, using the formula there. All right. We need to know what was the net book value of the building when the revaluation took place. So the net book value of the building was the cost of the building less accumulated depreciation. So the cost of the building was 3.6 million minus accumulated depreciation. We initially had 108 as the accumulated depreciation, but we added also the 36,000, which means it was now 36,000. 3.6 million. 3.6 million minus 1116. Okay, which means the building had now an NBV of 2.484 million. Okay, but this building was now revalued. The revaluation was now, according to the question, the building was revalued to 3.072 million. So revaluation 3.072 million. Alright, so any gain, what's the any gain? You can see that the revaluation is more than the NBV. The NBV is this one, 2.4884 million, but the revaluation is larger, so there was a gain. The gain there is the difference of 3.072 minus 2.484, which means 588,000, which is this figure. That was the gain on revaluation. This is the gain that appears on the revaluation reserve or the revaluation surplus in the other comprehensive income section of the statement of comprehensive income. So automatically when you get this figure, then you can get this as your balancing figure. Simple, isn't it? Thank you very much. Now, there is what is called an asset register. This is a record that gives more detailed information about the asset. Okay, about the asset. It is a memorandum record. It is not part of the double entry bookkeeping system. It is like the receivables ledger or payables ledger. You know all those things. All right. So the register has a page for each non-current asset. It is a manual system, remember. Okay, so what is the information contained in the non-current asset register? We have got the information concerning the cost of the asset, the debt the asset was purchased, accumulated depreciation to date, and then depreciation method that is being used. All right, then estimated residual value, the supplier's name, address, and the item serial number, location of the asset, date asset was last inspected, and date asset scrapped or sold. But why do we need all this detailed information? More detailed information is required. For example, when an asset is sold, its depreciation to date has to be transferred to the disposal account, so records are needed of how much depreciation attached to each individual asset. Similarly, if we are using straight line depreciation method and an asset is fully written down to zero book value, no more depreciation should be applied to it. Okay, ladies and gentlemen, I hope you have been helped. If you need more coaching, please call me 24/7 on +263 774 596 368 or visit my website at Transcal at www.transcalconsulting.co.zw. We are there to help you to ensure professional accountants is spread to the very end of the globe. Thank you very much. Until we meet next time, may the good Lord continue to bless you abundantly forever and ever. Amen.